Hello friends! Today we have a very exciting topic to dive into, the Forex market and how it actually works. If you've ever been curious about the dynamic world of Forex trading, then stick around till the end because we're going to break it down in very simple terms for you. Alright, let's start with the basics. What exactly is the Forex market? Think of it as the heartbeat of global finance. Forex simply stands for foreign exchange, and it's a market where currencies are traded against one another. The simplest and most intuitive example for this would be when you travel abroad for vacation. Let's say you are a US citizen traveling to Europe, let's say to France, Paris, for a short vacation. And now you want to exchange your US dollars with a local currency, which would be euro. This is actually the Forex market on a small scale. On a broader scale, Forex market is the market where banks, nations, businesses, and also individuals participate. The individuals we also call retail traders. And that's also the category which we fall into. Before we dive into the technicals, let's actually discuss about the history of the Forex market. Our story begins in the most ancient of times, where merchants would exchange goods for one another. Later on in history, we switched to currency exchange, and in the 19th century, gold provided the standard for international trading stability, which now brings us to the Bretton Woods Agreement. In 1944, representatives from 44 states gathered in Bretton Woods, New Hampshire, to establish a new monetary order. They created the International Monetary Fund, also known as the IMF, and fixed exchange rates to the US dollar, which back then was linked to gold. Later on, in 1971, President Nixon actually severed that link between the US dollar and gold. This led to fluctuating exchange rates, which actually allowed currencies to move with current supply and demand flows. While this did bring more flexibility, it also came with more risk and uncertainty. In the 80s and 90s, we later had our technological revolution. And now electronic trading platforms would totally transform our idea of trading. And the pinnacle was when in the late 1990s, online trading platforms actually made trading accessible for us retail traders. Obviously, in such a big market, you need certain regulations. And these regulatory measures were implemented to ensure fair practices and market integrity. Today, the Forex market is one of the biggest markets, exceeding a daily trading volume of over 7.5 trillion US dollars. But now let's address the elephant in the room. Forex trading actually allows us a unique chance to tap into that global market and make profits from those daily price fluctuations. But how does it technically work? It's all about currency pairs. When you're trading a currency pair, you're actually buying one pair while selling the other at the exact same moment. The value that you have during trading represents the ratio between those two currencies at that moment. Examples for this would be Euro USD, GBP JPY, AUD, Swiss francs. You have every major, minor and exotic currency, and they are all linked to one another in specific pairs. And here's the kicker. When you trade, you don't need any actual physical goods. The only thing you're trading is the price movement. How does it practically look like? Let's say you're trading Euro USD and you believe that the euro is going to strengthen compared to the US dollar. In this case, you would place a buy order. If euro moves in the direction you anticipated, then you would make a profit out of that price movement. If it were to go in the opposite direction, then you would make a loss of the exact same size. Forex trading serves both hedging and speculative purposes, giving you a range of strategies to choose from. What you need to remember is that you're always dealing with two currencies at a time. Think of it like a dynamic duo. Euro USD, GBP JPY, AUD CHF, AUD CAD, they are all listed as pairs. In those pairs, we identify a base currency and a quote currency. Let's say Euro USD again. The base currency would be euro. The quote currency would be US dollar. The exchange rate is actually just the ratio between those two pairs. Let's say that Euro USD has the exchange rate of 1.17. That basically means that you would need 1.17 of the quote currency, so of US dollar, to buy 1 euro. Why is this all important? Because as a trader, you make profits from these exchange rate fluctuations. And the good thing is that you can make profits no matter whether the price is rising or falling. Why is this all important? because these actually enable traders to make speculations on those price movements. So the thing that you're actually speculating on is whether the base currency is going to weaken or strengthen against the quote currency. And then you can place orders, trades, in both directions. This now brings us to the bid and the ask price. The bid and the ask price are two key numbers that you need during trading. Let's start with the bid price. This is the price at which a trader can sell a currency pair. A simple analogy would be you have a video game and you go into an old video game store and you want to sell your video game. The highest price which the merchant would be willing to buy that video game from you, that would be your bidding price. So translated into trading, the bid price is the highest possible price a buyer is willing to pay to get that currency pair. The ask price is the exact opposite. This is the price at which a trader can buy a pair. Think of it as going to a tech store and buying a new phone. When you go into the store and you see the price tag, the price which is on that price tag, that would be your ask price, because that is the lowest price at which a seller is willing to sell something to you. So translated into trading again, the ask price is the lowest price a seller is actually willing to accept to sell his currency pair for. Now, another very important component is the difference between the bid and the ask prices. This is also known as the ask-bid spread. It's a key component of trading because it's an initial cost. And the tighter, aka the lower the spread is, the better it is for the trader, because that means that you're getting more value from the very beginning. Let's dive into another important concept, which is leverage. In Forex, it's very important because it amplifies your potential wins as well as your losses. It's basically a Forex magnifier. It allows you to control a larger position even though you may have smaller capital. Let's say you have a capital of $1,000. If you have a leverage of 50 to 1, that means that you can actually control positions in the value of $50,000, even though your actual capital is only 1,000. Leverage is a very powerful tool because it can amplify your wins if the market actually moves in your anticipated direction. But it's also important to understand that it can go the other way around as well. And if the market goes against you, your losses can accumulate rapidly. Let's take a very practical example. Let's say we have trader A who has a capital of $1,000. He is analyzing the NAS USD chart and is anticipating that the price will be bullish. That means that the value of NAS will be rising. Therefore, trader A opened a buy position on NAS USD. Let's say that his leverage is 50 to 1 and that he goes in with a contract size of 1 lot. So now trader A opened a position using $500 of his capital as margin, but actually controlling a position worth $25,000. If NAS USD were to rise, let's say 2%, he would make a profit of $500. If it were to decrease by 2%, he would make a loss of $500. And that single loss would depreciate his account by 50%. Now let's talk about trading platforms. These are the digital spaces where traders execute their orders. Choosing the right trading platform is essential, and there are various options available. The most known and popular ones are MetaTrader 4 and 5. Because these are known for their user-friendly interfaces and extensive technical analysis tools. Okay, so now with the trading platform, you can execute your order. But how does the trading platform actually know where your money is? That's where the broker comes in play. The broker is where you deposit your money, and your chosen broker actually gives you the access to your trading platform. And it's not only about reliable technology, but also reliable execution, because the broker ensures that your trading platforms are not only accessible, but also secure. They enable access to a variety of markets worldwide, which can be traded manually or with the assistance of expert advisors to customize automated trading strategies. But when can you actually trade? Luckily, the Forex market never sleeps, which means that you can actually trade it 24 hours 5 days a week, so during work days, usually starting late on Sunday until late Friday evening. Because the hours span a range of different time zones, we also have specific important trading sessions, known as the Australian session, the Asian session, the North American session, London European session, etc. Understanding these different sessions is important because each of them come with their specific characteristics, and also currency pairs can be traded differently in different sessions. Okay, so now that we've understood what the Forex market is, where it came from, and how it actually works, what is the reason you should actually start trading in the Forex market? First and foremost, the Forex market boasts exceptional liquidity, providing traders with a smooth and seamless trading experience. So this basically means that currency pairs can be bought and sold with ease and minimal fluctuations. As for the flexibility, the Forex market enables traders to trade a range of different strategies, whether it's scalping, short time frame trading, or swing trading, so keeping positions open for a longer period of time. The market is constantly available and every trader can find a strategy that suits themselves, their psychology, as well as their lifestyle. We also have a wide range of currency pairs spanning from major to minor and exotic pairs. Each of them have their own characteristics, and determining which pairs best fit your strategy is also a very crucial factor in trading, because you can choose to focus on those pairs which on average give you the highest return over time. That concludes our first lesson in Forex trading. You've now got a solid foundation to build upon. Remember that practice and continuous learning are key. And in our next lesson, we'll explore more about Forex trading and actual practical tips that will help you make informed decisions every day. So stay tuned.
Hola Prime, trade with transparency.